Welcome to the Dividend Talk podcast, episode 34, Annual Results 2020 from Dividend Stocks. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to this channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Good morning, European DJI. We finally got through that intro. It took me a couple of attempts, and we've had to change the heading. So we had dividend day Thursday night, and my key takeaway from that was that non-English speakers can speak better English than native English speakers, and I think that's proven because I couldn't say fiscal. I was saying physical and all sorts of words. So we've changed it to annual results just to help me out. But how are you on this Saturday morning?
Wasted because of dividend day first, and then I went too late to bed. It was fun talking with like-minded people, and then last night as well. So I'm just wasted. But I think we'll have a lot of fun today because we have some great news items to talk about. Great annual fiscal 2020 year results, and I think a nice stock pick, and some great listeners' questions as well. So
cool. So we might start with some news. I know you're wasted, but we'll go with you first.
Oh, okay. So actually, I want to really share kudos to Matt Money, our YouTube guy on Twitter, because he lost 50K in trading a naked call options on GameStop. So 50K, I mean, wow, that is like, what is it? 100 euros of dividend per month. Yeah, that he lost. So what he did is he sold $100 naked call on GameStop. And then when I watched this video, he got afraid when it went to, I think, to 300 that the bank would call him up and start liquidating his portfolio for making sure that he has the money behind it. So he sold it. Yeah, and we know where the stock is now trading, right? So it was like a 2-3 day hike, which cost him 50K.
Yeah, and it's, I think it was about $60 at the moment. So that's a hard hit to take. And it's my main problem with options. I follow Matt, and I've seen he's made some of these. I'm going to call them gambles, because if you're with naked call or puts, it's a gamble, really, and some of them have paid off, but it only takes one bad one to go the wrong way, and I think he's learned a pretty harsh lesson there. Well, fair play to him for putting it up, because you don't see too many people putting up their losses. It's all to the moon, baby, and all this kind of carry on and how much they make. So fair play to him, and I hope it's a lesson to other people getting in. Don't sell naked.
Yeah, never. Neither in real life. But I will put the link to his video in the podcast description, because because of this, he's really genuine. I've got a lot of respect for him in his videos, and if you watch his video, he's really open about it, and he really shares his lessons in an honest way, and I have lots of respect for that. It's just pity for him that it cost him 50K.
Yeah, but better 50K than liquidating his portfolio.
Yeah. Okay, and then the next item, which I found really interesting, and I don't know, this doesn't hit FinTwit often, right? Such kind of news, but there has been a breakthrough in quantum computing, and it's not IBM. We know IBM has the most patents in the world, but again, they are lacking on innovation. But Microsoft and the University of City had a breakthrough in quantum computing because they were able to go from 50 qubits to thousands of qubits. And why this is so important? Because if you look at some of the biggest challenges that we have in the world, for instance, curing cancer, it's a computational problem that we have in the world. And making this progress in quantum computing can really, really change life and the economy how we know it today. And the fact that Microsoft is part of this just makes me, after their earnings from last week, that this makes me so much believing in Microsoft for the next 30 decades. And this is just a news item that you find somewhere in the corners of the internet. But this is huge for me. This is really huge, this kind of technological breakthroughs.
Yeah, it's big news, and Microsoft being on the forefront of this is huge for them. They can't do anything wrong at the moment. Every step they make seems to be positive. But in terms of the computing world, and as you said, for healthcare research companies, quantum computing can be massive, and hopefully it paves the way to eliminating cancers and all these kind of diseases. So yeah, no, it's good to see this. Imagine where it'll be in 10 years' time.
Yeah, exactly. These are proper moonshots, right? Not the Google ones, but these are proper moonshots for me. Yeah. So what did you see in the news this week?
I've been inspired by Wall Street bets this week. So all I've been reading is To the Moon Baby with rocket ships. So I came across a few articles about space, and the first one was China. Actually, they're up in space at the moment. Their space shuttle, I think it's Taiwan 1, is on its way to Mars at the moment, and it released its first shots of Mars. They're about 200 million miles away. I think they'll be close to orbit actually in the next 4 or 5 days, so that'll be interesting. But what I found interesting with the shots of Mars is, first of all, it was white and grey, but they took grayscale images. And the second, it was flat. No, it wasn't flat. It was round. But I mean, this technology is crazy that it can go so far away, and they're communicating and sending these pictures back to Earth. So it's a good mission, and it shows that the space race is back, isn't it? With China up there.
Mm-hmm.
We've seen Jeff Bezos has stepped down from Amazon, and he's focusing on other projects, and one of them is Blue Origin, which again is involved in space. So we mentioned that space might be the new trend going forward for the next couple of years, and it's looking that way. I'm hoping IBM might release something and put blockchain up on Mars or something, so they might take off a little bit.
Yeah, I think they don't have a mainframe anymore in the rockets. But imagine that you would go to Mars, right? What would you do with your dividends?
I have absolutely no interest in going to Mars, none whatsoever. But my son does. And the first, like he was the one who brought this to me, and Jeff Bezos, and his first question was, why is it white and not red? And I had to explain what grayscale imaging was and how that works. But I mean, anyone that wants to go to space is more than welcome. But I don't know. I just rather stay in Earth, to be honest.
Cool. So let's go then now to the main topic of today. Let's talk dividends and dividend stocks.
Cool. We talk some earnings. So we have ABBV first, a really popular healthcare company. So if you might want to give some figures, I think you've done some research.
Yeah, so let's say just the headlines, right? How I look at the company before I give some of the figures. So what I just like about this year is that they have integrated Allergen now, or Allergan. I don't know how you pronounce this. So it's really integrated now. Humira did still pretty well in the United States. In Europe, there's a decline. So what I've been just seeing is that they've been really diversifying their portfolio. And what I also really liked is that other drugs are starting to pick up now. And this is maybe also a good one. I was talking with Dividend Wave about it. And if there's any reader that understands this kind of language, but they had a non-cash charge for Skyrizi contingent consideration revaluation based on higher estimated future sales. So we both don't really know what this means, but what we do know that the Skiriji drugs is really, really, really popular at the moment, or really doing well. And if we see about how it's growing, and Dividend Wave shared me a nice picture, it's actually growing a bit quicker than Humira in the early days. So we are just a little bit confused about the language here, what this means, because they are having a big impairment, which is impacting their quarterly earnings negatively. But it sounds like they probably have a deal, an in-licensing deal with the company that actually developed it, and therefore, because the drug became more popular, probably there has to be something with the asset side of the balance sheet. But we're not getting totally our understanding. We need to wait for the annual report itself to fully grasp it.
Yeah.
But it shows the diversification of their pipeline, and they're really knocking it out of the park with these new drugs. And I think this will give the cushion to the Humira impact of biosimilars. And the GAAP EPS is of course lower. It's around $3, let's say, a little bit less. And I said the non-GAAP EPS is around $10 and a bit. Which means, depending on which you prefer, in this case, I think it's fair to go more towards the $10. Well, you get it for a multiple of 10. Yeah, and next year's earnings are expected to be around 7 for GAAP and 12 for non-GAAP. So again, you get it really for a low multiple at the moment.
It sounds really, really positive, particularly with the Humira drug. I know the patent has run out or the patent has run out in Europe. Is that right?
Mm-hmm. Yeah.
But it has another couple of years to go in the US, which is probably why the sales. But it's encouraging to see other drugs come, because that's the biggest concern, isn't it? That's why they were undervalued around $70-$80 for a long time.
Yeah.
We might see them pop now that these concerns are being washed away. So no, sounds good for me. I hold ABBV. I haven't looked at the results. I'm just looking at that non-cash charge, and it looks like you're right, they must have some agreement for future sales, or it might be at a set price. I'm not sure why it would impact them negatively now, but no, I'll keep an eye out for that when the annual report comes. So you're a happy investor?
Yes, so I've got a full position already for a really long time, and this is for me really like a buy and forget, I said, almost investment, because I hardly look at at Abbvie. The only thing I do is every quarter I quickly check the headline around how the biosimilar impact is. That's the only thesis that I have that could impact it negatively.
Yeah, and it's the same with all these healthcare companies and drugs. It's the same for each one. Cool.
So then also, Shell reported earnings.
Yeah, Shell reported earnings, and for me, this is one that I'm really keen and interested in. I've watched a couple of videos on this from Jessica. Oh, I don't know how to say her surname. She's the chief financial officer, and also from Ben, and both of them came across very, very well. I saw an interview with Ben actually, and he was asked some hard questions. I mean, you look at the figures, and I'll talk about them. They're not great. They don't stand out. On you. But if you focus on what they're not saying or what they are saying in the interviews, it gives a really compelling case. They kind of explain why they've had to cut the dividend and the impact of that, and we're starting to see the benefits of that. But I'll talk through it a little bit. So Jessica was really talking about how they've started to divest non-core positions. So projects that were not making money or were just useless, they're just getting rid of them, and they're trying to simplify the business model a little bit, which simple is always good for me. Their marketing, they've really pushed the marketing side on this call. They've seen an increase in digital services, retail stores, and Asia has popped a little bit. So they've really pushed that side of it. And the nice thing about that is that it's independent to the price of oil or the gas position. So it's nice to see that side of it doing well. It gives it a little bit of diversification and a little bit of a safety net. It was, I think last year was all about cost discipline, and I think that's the message that I was getting. So obviously they reduced the dividend, but they were also reducing OPEX, operational expenditure, capital expenditure, and they've done a great job at doing both of them, and they've really tightened up their balance sheet a little bit. They still have a high-ish amount of debt, and their main goal is to reduce that to 65 billion. It's around 74 billion at the moment. And they have come out and said that once it hits 65 billion, that's the priority. They will then distribute 20 or 30% of operational cash flow to their shareholders. So that's encouraging. I mean, it took them less than a year to get that down 4 billion. So I know it won't be a straight line, but we could expect to see that in the next 2 years.
Well, don't forget that last year they had also a negative oil price for the first time in history. Yes, so 4 billion. If you think logically, then next year they should be able to actually.
Of course, if price goes up, and look, we don't know, and he was asked to give a hard date on that. Ben was, and he sidestepped that and said, "Look, there's too many variables. I'm not going to give you a date, but what I can guarantee you is that once it hits 65, we will reward our shareholders," which is quite encouraging for me. They did increase their dividend by 4%. I don't understand why. I mean, I mentioned the figures. Volume was low, revenue was low, earnings dismal. Everything was as you expect with the low price. So I didn't see the need to increase it. They've already increased it 2 quarters ago. So I'm not sure why they felt the need to do it now. It's nice, but I'm happy enough with how they are, with how they handled the situation. It gives me more confidence of why I didn't sell them as a dividend investor, even when they cut there.
Maybe they feel regrets, and they've been reading the Reddit forums and are afraid that they will go to the moon anytime soon.
They probably cut it too much. Maybe they thought 66% was too big of a decrease, and now they're trying to just get it back. Or the uncertainty was so, like, we see that the oil prices, and I know they've had some restrictions. There was hurricanes in the Gulf of Mexico, which is causing problems. There's this OPEC plus restrictions. So there's a lot of uncertainty, not just COVID, that was sitting around shelves. So they made a hard decision. That really stood out for me, is that, look, they didn't want to make this decision, but they've did it. And we're going to look at Exxon Mobil in a few minutes, and we'll see the difference. And for me, I'm happy enough that the numbers can improve, but we should see that then as oil and prices increase. So disappointing in numbers, but from what they're saying and the direction that they're taking, I'm happy.
And if you look at the market reaction, it was quite okay, because Shell share price did quite well. So I think the investors saw no surprises in these reports.
Yeah, you mentioned management quite a lot, and Ben is one that I really like. He seems to me there's no bullshit. He seems to tell it straight. There is a little bit of fluff sometimes around his answers, but it has to be. But he seems to be straight down the line, and I really like that. And it gives me confidence that when he says they'll reward us at 65 billion, they'll do that. Or it gives me confidence that when they say they're trying to do this, that they are actually trying to do it. So,
well, the fact that he's the CEO prevented me also from selling the shares, because he's really genuine. You can just see that with everything.
Yeah,
I would almost say that he cares about us.
Let's not kid ourselves.
Okay, so then I actually watched in another. Well, I think they are both British now. You could almost say, not anymore Dutch British. So I read up on Unilever still in the remaining time that I had to prepare. And what I really liked about Unilever is that they also really set out this strategic framework. So besides the earnings, right? Probably it's good to mention. Their underlying earnings per share are around €2.5, which is, if you do that for a multiple of 20, it would mean a 50 euros. We saw the price drop significantly, about 8% or 10% even in those 2 days. So I don't understand why the market is reacting like that, because for me their earnings were quite good. They had deleted earnings per share of €2.12. and their free cash flow went up from 6.1 billion on an annual basis to 7.7 billion. What is important to know that the free cash flow is being pushed up mainly because of they just lowered their capex, their capital expenditures, which means in layman's terms for us it means like just ordinary cost cutting. And what they also did, they increased their focus on receivables, which means like they asked their vendor management department probably to chase up all the people they still owe money from or still need to receive money from, and tell them to pay quicker. So that's how they have been able to really improve their cash flow. But this is really good news because it also allowed them to, pay down debt, if I remember correctly. So the debt figure looks much better. So all in all, I think they did the right things. Their earnings are stable. They increased their dividend also by 4%. So for me, the opportunity that we saw of the share price decline is really great now. I own already a large position, so I'm a bit more greedy maybe than others. But if you want to have a decent European company, I think it gave you really a nice entry price at the moment. And therefore, I also sold a put option on 42 euros, expiring in March, I think, which gave me 45 euro as dividend income. That's how I look at it, because I'm willing to buy 42, because for me the magic number is 42 or comma 68, because that would mean exactly 4% yield, and that's for me a really nice one to get Unilever at.
Yeah, I have to admit that I bought them as well when I seen the dip. I quickly went through the numbers, and nothing really jumped out as to why they dipped so much. So I bought an additional, I think it was 10 shares. When I was reading, they were focusing on this strategic framework that they have, and I think they mentioned somewhere that 60% was winning market share, which is quite good. And I'm actually I was never really aware of Unilever maybe 12 months ago or their products, and they are everywhere. I was down in our, it's like where we used to buy stuff for our cafe. It's like a wholesaler store, and I was walking through. The amount of products there, I mean, from gravy to everything down there was Unilever. I was taking pictures, and I was there to my sister-in-law, buy this. I have shares in this company. Buy this. But they're just everywhere. So I'm quite happy. The dip is welcome for me. They dropped under my cost basis, so I load up. I haven't quite got to selling puts on them. You're obligated to buy 100 shares, so it's probably out of my range at the moment. But yeah, no, it's a solid quarter, and I can't explain why they've dropped.
Yeah, and what I like about their strategic framework, right, and we've seen that already a little bit, but on in particular, and this is maybe also the new CEO. I mean, he is already for 2 years now, I think. But their third strategic choice is to accelerate in the USA, India, and China, and leverage our market strengths. For me, this is really the main catalyst of Unilever, the emerging markets in Asia. I think they have so much still to do there. And I saw that, for instance, they introduced Domestos, their cleaning product for toilets and such, in China. And it increased their sales, I believe, with 25% here. And I think there's so much opportunity for a company like Unilever still there, which should give us growth. And now to really focus on that as one of their 5th pillars makes me really bullish on the long-term future of Unilever. And last but not least, they have also this purpose-driven brands that they focus on as one of the pillars. And they have this kind of Beyond Meat equivalent, which also grew 70% during pandemic times. So and they have also the Dollar Shave Club. So they're also really into these new fancy startups, and that's what I really like about Unilever. And they can scale those companies, right? That's the interesting part.
What's this Beyond Meat? Is that for vegetarians
So
or
Beyond
vegan?
Meat is not from Unilever, right? Beyond Meat is this company which is fake meat effectively, and they can create a meat equivalent in the lab, and they produce that. So they sell burgers now, I think, with Burger King. And I think the one from Unilever, from top of mind, I think is called the Vegetarian Butcher. I think it was a Dutch startup that they acquired not long ago, and they are now scaling that to a global level, and they're selling all this vegan-based meat that tastes like real meat. So for someone like me who has a vegan diet, this is brilliant, because from time to time I just go to the shop here to the Lidl, I buy such a vegan burger, and I can just as much enjoy the style, the lifestyle, let's say, of going to McDonald's.
Yeah, it's interesting. I don't know if I could bring myself to eat something that's made in a lab, but I mean, I do. My sister-in-law is vegetarian, and she does miss out on, when we go to McDonald's and places like that. She'll go and she might buy the chips or something, but it's not the same experience. So I can see the appeal for non-meat eaters to go down this route.
EMF, wake up, it's 2021. Tell me what's not made in the lab. Everything that the cow puts in the mouth is made in the lab.
I make everything out the field out my back, all organic. Okay, we'll move on. So we have a couple more. I kind of briefly flicked over Aflac last night. So I didn't go too deep into them, but I just had a quick look at the figures. Actually, Dapper Dividends has a video on YouTube about them. He analysed, which kind of helped me summarize them in about 7 or 8 minutes, which is quite cool. So the first thing to say is that they beat earnings expectations. They had a strong year in Japan, so it was up 3% year on year in that quarter. I think about 3.9 billion. Their earnings, their tax adjusted earnings, was 8.5%, and their net investment income was up 16%. The US had a bit of a weaker quarter. Revenues were down due to lower premiums. Pre-tax earnings were down 32%. And then we know Americans like to claim and sue, so there was a lot of COVID-related claims which kind of impacted them there. So we'll start to see that even itself out over the next couple of quarters as vaccines are rolled out. They bought back, they were quite aggressive in their buybacks. So in the last quarter, they bought back 11 million shares. So they also increased the dividend by 17.9%. So it was kind of a so-so quarter for me. Strong in Japan, weak in the US. Over the full year, they were a little bit better. The revenues were up. It was up 1%. Earnings were up, and I think they spent 1.5 billion in share buybacks. So they really are rewarding their shareholders. I mean, we're seeing huge hikes in dividends. We're seeing share buybacks. And I mean, look, they're a solid company. They've been paying dividends for, I don't know how many years. They're dividend aristocrat. Insurance in this game, I don't see real problems from coming in. I imagine the US will flatten out once COVID goes away, and they're taking, Japan is doing really well, and also their investments. So they invest in companies and stuff. It seems to be paying off quite handsomely. So it's kind of a standard report from them. Have you? I know you were mentioning you were thinking about buying them. Did you buy them in the end?
No, not yet. It didn't get to the price for which I want to own it, and this might be just one of those companies that I will regret not purchasing on time.
Yeah.
But what I've seen in Aflac over time, they always have big dips in there. So for me, it's just a rock solid company, and I'd love to really initiate a position in it at a certain moment. And if we look at other insurance companies, right, they all have this a little bit. COVID-19, the natural disasters, as how as how they call it. It's in all those reports. But remember, for an insurance company, this was probably one of the worst years in their almost history. Yeah, if you think about events being cancelled, that they all insured, all these kinds of things.
Yeah.
So
yeah, like for the year that we've had, the results are pretty good.
I would say so, yeah. Okay, so let's do a mind switch again. Let's go to Exxon Mobil, and I will keep it relatively quick, or maybe not, actually. So Exxon Mobil is on my, let's start with it. Exxon Mobil is on my list to sell. I've been studying it. I wanted to wait for these numbers. But I've got also a doubt there. So look, and I tell you, and I'm sharing this because I think many investors might have this, because I've got quite a large position. I've got, I think, 150 shares in Exxon Mobil, which is quite significantly, which also means it gives me quite significant dividend income, which I'm using to reinvest so that I have the snowball quicker. So I think the yield, I don't know, I didn't check for 2 or 3 months, but the yield is probably around 7%, somewhere 7-8%. So I was thinking, okay, I would like to start dollar cost averaging myself out in ExxonMobil, but I don't want to give up some dividend income. Yeah, so this is really where I have the dilemma at the moment, because what can I go then? I can go to those 2 European companies, Enagas, Red Electrica, which I don't want to be 2 big positions in my portfolio. I have already enough Abbvie and the other 5-6% yielders, so it's not really an alternative for me at the moment. So this is how you should know that I was looking at these fourth quarter results. So what I'm then looking for is some hope in this report. So, and then it's so funny, right? I mean, they are really a bunch of hypocrites at ExxonMobil. I mean, look at that. The third line in their press release was, "We met 2020 methane emissions 15% reduction and flaring 25% reduction targets versus 2016." Okay, and then it comes, "and announced 2025 emission reduction plans." And here I start really laughing. "Projected to be consistent with the Paris Agreement." Now, if there's one company that's a hypocrite by supporting Trump to pump more oil, and now mentioning the Paris Agreement means like, oh, come on, I can't take them serious. I think they put it in there for a legal point of view, that 20 years down the road, they can say, well, we mentioned that we want to comply to the Paris Agreement.
Yeah.
What a bunch of idiots. That's what I thought when I read that. Anyway, then comes the fun part. So they said that they said on the forward plans, cash flow this year expected to cover capex and maintain their dividend and strong balance sheet. So I don't agree anymore that they have such a strong balance sheet, because they've been really leveraging up. But what I'm happy with is maintain the dividend. And here we were talking on Dividend Day with, and Dividend Wave brought this up, that Americans are really, really focused on dividend growth compared to European culture. So, I mean, I have this major dilemma, and for instance, I've got 150 shares. I might just sell 50 shares over the upcoming quarter and try to reinvest it elsewhere. I will not straight away go to zero in this position overnight, which gives me time to find alternative high yield, because I have a mixture of low yield, mediocre yield, and high yield in my portfolio. But you know, this company, what I wanted to mention, besides their commitment to the dividend, their capex was, their free cash flow was horrible. It didn't cover at all. So what you need to know is their capex, they reduced their capex last year from 31 billion to 21 billion. This is 30% reduction, which is insane. Yeah, where you need to think about how they do that is by, and I met it here. So they removed less strategic assets from the company upstream development plan. But what you need to know about one of the valuations for an oil company is their reserve replacements. So they will have less and less reserves over time, which means that their future cash flow is again under pressure. So it gives now a nice hike in their free cash flow. But okay, they went to 21 billion. So I don't know. I don't think they can do it another time, 30% decrease. Yeah, this is amazing. But then they also have a 14 billion dividend commitment if they maintain it. So they needed cash flow of 35 billion. And their free cash flow, I think their operating cash flow, where do I have it? Yeah, the operating was 17 billion. So, and then minus capex, they would have a negative free cash flow of minus 4 billion. Yeah, so they're missing effectively, what is it, 14 billion to pay the dividend. They're just not covered at all. And this concerns me, because they want to have a good balance sheet as well. I don't know how they can do that. And they are thinking that they will be able to cover the dividends and the capex at an oil price of $50. That's all what it is about.
Are they being too optimistic, or are they just being naive?
What's the difference?
Optimistic. I suppose they have some hope, or they have some solid grounds as to why they'll be able to cover, or are they just like naive? Are they being foolish into thinking that they'll be able to cover? Because it doesn't look like they can. I can't see how they can cover it.
Yeah, I have the same feeling. That's why I'm bullish on Shell and bearish on Exxon Mobil. That's why. So the only thing why I'm not selling my whole position yet is because of their commitment to the dividend, and they kept paying it. So it gives me time to exit the position more naturally without having a really strong impact to my current dividend income, which I also need for reinvestment.
And with your dilemma, I mean, I'd imagine plenty of investors have this dilemma. Have you made a capital loss on the share price?
I don't care really about the capital loss from that point of view, because it allows me to tax harvesting on things that I would sell in the future. So I'm not, although you can say that the fact that I'm resistant to selling because of the dividend yield is an effect of capital share price loss. Because when I bought it, it was all around $70. Let's say it's now around $50.
Yeah.
So at $70, the dividend has a lower yield and will be easier to replace this company for another company in my portfolio. Yeah.
Of course.
So there is a correlation there. But you know, the nice thing about this one is that Exxon Mobil will not disappear overnight. So how I have been dollar cost averaging into that company for 3 years, so I can also take 3 years to dollar cost average out. I don't think that the price of the shares will go much lower than where it is around 45, 50, yeah, unless there comes a big crisis again, like last year, or unless they cut the dividend. From what I've seen and how committed the board of directors is, I don't see them cutting it on the short term, because they still have enough wiggle room in the balance sheet.
So to play devil's advocate here a little bit, given your thoughts that they won't drop in price too much lower, they have a healthy dividend yield that they will maintain. It might be a good short-term play for somebody.
Yes, definitely, it might be. Yeah, but you know, I'm not a short-term player. So, but indeed, if some people expect that the economy will reopen, planes are up in the air again, I can imagine that Exxon Mobil goes quickly back to $60 per share.
Yeah,
at least.
And you get 7% yield for that risk as well. So it might be a good short-term play. Okay, cool. It's interesting to see the difference between Exxon Mobil and Shell, isn't it? To compare how they both handled, and you look at Shell and they seem to have a kind of a rock solid balance sheet, and Exxon Mobil are just kind of scrounging the pennies to pay the dividend.
Yeah, and Shell is talking about the future more than Exxon Mobil. Exxon Mobil is not talking about the future at all. They're only talking about cutting, reductions, and I don't hear that. At Shell, I hear more a future strategic vision.
And I think this American mindset of having to pay the dividend may play a factor, because if Exxon Mobil cut their dividend the same as Shell, their price would tank a lot more.
Yeah, definitely.
A lot
definitely.
more.
Yeah.
Okay, cool. So what we'll do is we'll move on. We have a couple of companies left. We might just do a quick fire round to get them through. So we might look at Amazon. We mentioned Jeff was stepping down earlier. Have you got a chance to look over some of their results?
Well, I was just really impressed by the net sales that went up 44% in the fourth quarter. It's amazing. Yeah, 125 billion alone. And we had Apple, 111 billion in the fourth quarter. Amazon joined the club as well. It's amazing. It's really amazing what they've done. And they keep on growing, really, like everything is on fire. So also, what is it? 41 EPS per share. Compared to 23, so they doubled their earnings per share. It's amazing how they've grown.
Yeah, and they did well over the full year as well. I think their full year net sales was 386 billion. It's crazy numbers, crazy numbers. But it'll be interesting to see now once Jeff steps away. I know he's not stepping away completely, but how that will affect Amazon, Will their share price tumble because of this? Or I know the new guy coming in, Andy Jesse, I think his name is. He's coming in there, and he's been in Amazon a long time, so I'm sure you'll have some of the ethos that Jeff had. But it'll be interesting to see how it goes over the next year or so. So we move on to Google next, and I must give a shout out to Dividend Wave. When we were all speaking on Thursday night, I think we were all in agreement that his Twitter, these one pages of earnings, was kind of keeping us all going quickly on a lunch break. You look up Dividend Wave, and he must be a mind reader because he has nearly every company that you want to see. So keep it up, Dividend Wave, because we're kind of relying on you at the moment. So I took a snippet of his tweet on Google, and he's talking about revenue up 23%, net income up 43%, free cash flow up 105%. My only problem with that is that it's all odd numbers. I don't like odd numbers, so if it was 24%, I'd be happy. But I mean, it's crazy the growth that they have, and they're sitting on about 136 billion in cash. I mean, that's just. I mean, they have to start paying a dividend, don't they? Like a 1-2% dividend.
I would really hope that, and I own one share in Google. I bought it like at was it at $900 2-3 years ago. I'm keeping on to it because I just love the company Google and what they have done with the acquisition of YouTube. That was so smart. Don't know what their next big acquisition will be like that, but they just rocked the advertising place. And even though Facebook stepped in and became big in advertising and Amazon, they're still hitting it. And a great company to own, I think, and it might be a future dividend payer one day when we are old. Yeah.
As soon as you sell it, it'll probably start paying dividends.
That's how it usually goes, right?
Usually works. I mean, look, incredible company, so much cash flow, and their figures speak for themselves.
Yeah.
So we might look at Chubb. I know you have a position in them, so you might have focused on these a little bit more.
Yeah, for me, what was really interesting is that Chubb in 2020, and we just spoke about one of the hardest years for a company in the insurance industry. They increased their core operating income, net of tax, with 38% year over year, which is huge. I must confess, they excluded a lot of the, let's say the impairments. Otherwise, their earnings, let's say the what is the GAAP earnings, they look less pleasant, let's say. But I understand why they do it, and their book value went also quite up with, let's say, 7 to 12%. So for me, Chubb has done a really great year given the circumstances. We know that they had a lot of insurance policy around large events and everything, which got cancelled. But I think they did really, really well, and their full year consolidated net premiums went up by 5% to 33.8 billion. And this is what we were talking about earlier on the shows. Like the insurance companies will start to boom in the upcoming time because there will be more risk averse mindset when also the economy reopens. So they will want to protect themselves more for a pandemic or something like that. So I think Chubb will be able to write a lot of premiums on that as well. That's my thesis for the insurance industry, for companies like Chubb, Aflac, Nationale-Nederlanden in the Netherlands. I think you can expect a lot of earnings growth in the upcoming few years.
If I remember correctly, did you sell Disney and buy Chubb at the time?
Yes. So I sold Disney for around $100, and then I bought Chubb for $100. Disney is at 175, and Chubb at 162 or something like that. Yeah. So you don't need. People always tell me, why did you sell Disney, such a high quality company? Well, because they're not a dividend payer that I can count on. I'm not so bullish on some of their business, right? The cruises, the parks, all's closed. So you buy it purely for the Netflix competition, which they won't be profitable on for the next few years, right? As per their estimates. So I bought Chubb, boring insurance company, and from a capital price appreciation, because that's why people come to me, right? For the capital price appreciation. It's almost similar. I just get I just get a reliable growing dividend with it.
Yeah, turned out to be a good choice. Okay, we might squeeze in one more. We might have a look at ABB. So they've done not too good from what I can see. If I'm reading these figures, okay, their orders was down 9% over the year. Revenues look like they're down 4%, and their operational EBITDA was 787 million, and their margin is about 12%. The basic earnings per share was actually up 785%, which is crazy. I'm not sure why it's up so much. I'm not missing a dot or a comma there, am I? I don't think so.
No.
But the operational earnings per share was down 36%. The cash flow from operations was 408 million, but it had a negative impact from pensions and stuff of about 273 million. So it doesn't look. I mean, it's a strong underlying performance, but I'm not too impressed with any of these figures.
So actually, I have a little bit of a different opinion on that, because you need to know this is a cyclical industry, heavily cyclical. So for me, they actually, knowing that they did quite well, and I guess they used it kind of as a kitchen sink year to quickly also do the pension balance sheet clean up. Yeah, so I'm actually quite no. If you think that the world closed down, which means that governments had other things to think about, infrastructure projects being delayed, I think an order decline of 9% is not that bad actually for such a cyclical company. And remember, they also deliver a lot to the oil and gas industry. And we just spoke about that Exxon Mobil declined their capex with 30%, which is impacting a company like ABB, right, in the supply chain. So not too bad, I must say.
Okay. Do you have a position in them?
No, but I've been looking at them to consider them maybe as one of those positions in my portfolio. I've got Siemens, and I could have a second industrial company, and I'm not interested in General Electric. So for me, it would be ABB or a company like Honeywell as an example that I'm eyeing.
Have you ever looked at Rockwell?
No.
Okay, they might be a good alternative as well. Okay, cool. So we'll go into some listeners' questions. We have a couple this week. And the first one actually is for you specifically, from the Wolf of Harcourt. And he said that you've mentioned before you have 10% in what you call mad money growth stocks. So he's a little bit curious to know what's in it and how is it performing.
So what mad money means for him like grandfather's money, probably. But I've got it in Facebook, Google, and Alibaba. Those are my three main non-dividend payers, where I'm investing more for the growth and tech as a combination. But I'm then having a favor for cash-rich, more mature companies already. So not the early startups.
Okay. Yes. Phil has asked us a couple of questions. What's your go-to website for daily financial news?
CNBC. How about yours?
I use Reuters quite a bit, or Bloomberg. And what's your favorite go-to website for financial data?
So when it's dividend data, it's IO charts. When it is company data, it's Morningstar.
I prefer to go to the investor relations of most sites, but I've also come across this site called Ticker. I've wrote about them, and they seem great. They have both US companies and European companies, so it's a really good site. I normally check the first 2 or 3 years of the financial statements to make sure that the data lines up, and then I'm confident then with the rest. So that's who I use. We have one last question from Tony from 1millionjourney.com. And he asked us about our view on investing in gold.
Yeah, I've thought many times about buying some gold, but it's the same as the question about Bitcoin. I don't understand it.
I can see the value in it. I mean, when I started investing, I bought some gold. I quickly sold out of it because, again, I didn't really understand, and it was just flatlining for a long time. But I can see the benefit of a dividend investor holding it and protecting it against fiat money devaluation. So I can definitely see the benefit, but I just don't have any at the moment. I have a question for you, European DJ, and you mentioned Unilever earlier, moving more into emerging markets. What's your view on emerging markets in the upcoming decade? Because they've really underperformed the last decade.
So you need to know, I've been in India myself a few times, and in other countries in the region, work related, and the middle class is booming there. And the colleagues that I was talking to, they are really hyped up on things like Apple and Western products, and they feel, what I noticed, they feel like it's their time now to become wealthy, which means that they are also more likely to use products from Unilever over time. What I also, and I don't know if many people know this, but Unilever does a lot of local production and does a lot of local goodwill, charity as well, because they are this purpose-driven business. So that's why I'm so bullish on Unilever in emerging markets, because they are kind of co-creating the market there with NGOs, citizens. And for me, this is really, really powerful, because it means that people will have more interest in their brand, more loyalty to their brand. So that's my view. The middle class is really rising. I can see that. I see it on my network. So I'm really bullish on it.
Yeah, what's caught my eye is you follow some of the large investors, and Ray Dalio is one that I like to follow, and he's moving a large portion of his portfolio into emerging markets. Now he's buying up some ETFs, but it seems to be it's notable that all these big investors are taking money out of the US. I mean, the US is at all-time high and shifting slowly into emerging markets. So I'm wondering what the next decade will bring, and it's making me wonder whether I should. I don't like buying ETFs, but I don't know enough about companies in emerging markets to just maybe get a little bit of exposure into that for the next couple of years. But it's something that I'm reading up on, so it's nice to hear your thoughts on it. Okay, so we will move on to the last section. I don't think we have any more questions, and we will move on to the stock recommendation. I think I'm just going to pick a bank just for you, because I know you love banks.
But you took a nice company, actually, a nice European company.
Yeah, and it's one that's been overlooked for a long time, and maybe because it's on the Swiss exchange, and the exchange rates fluctuate quite a bit, particularly with the US. I mean, there's quite a fluctuation in that, but I believe they're one of the second largest pharmaceutical company. But really, they're a pharma and a research-based healthcare company. The R&D plays a huge role in what they do. They were founded in, I think it was 1896, so it's 120 years old. But what's quite nice about them is that the founders, I mean, their ancestors are still involved in the company. So it's still, even though for its size, it's still family orientated. And when you read their annual reports, it really sticks out that family, employees, welfare of it kind of, or you get that family feeling from it. Like, and I really like that. You go through and they have captions of people that work from or people that benefit from their products, and it gives you a nice feeling about the company. And they operate under two main divisions, as I mentioned. They operate under pharmaceutical and diagnostics. The pharmaceutical includes Genentech and Chubb, so they are both Japanese and American biotech companies, and they do quite well. And then their diagnostics, then they have diagnostics in diabetes, molecule. I can't even say that word. I even say tissue diagnostics and so on. So their goal is to use both pharma and diagnostics, from what I can read, to generate a more individualized healthcare process. So like your healthcare will be individual to you and not just some generic drug off the shelf or so on. And it's quite interesting. One concern I had about them before I was reading through is that they're heavily reliant on cancer drugs. I know now they've started, the R&D have started to look into MS, and they've released products, and they've started to diversify. And new products, I think, made up of 47% of their sales last year, which is which is quite interesting. But from a dividend point of view, they've grown their dividend over the last 34 years. I think what's confusing for US investors is that the currency fluctuations, you look at the dividend, it hasn't grown. It hasn't grown the same because of those. But in terms of Swiss franc, it has grown every year. Earnings per share has grown every year. And they look quite good. I briefly looked over their earnings this year, and they've performed quite well. Their payout ratio is close to 70%, which is a little bit on the high side. But I mean, you spoke about quantum computing earlier, and this is one of the things that really stood out for me is their innovation within the R&D, moving into different drugs, but they're starting to utilize this quantum computing for stuff like Alzheimer's and cancer. So they seem to be at the forefront of that. And I know Microsoft is developing this technology, but I can see a company like Roche coming in and taking over and really using that technology to help people. And if that takes off and you can cure Alzheimer's and cancer, I mean, I don't see any limits for this company.
Yeah, I mean, it's one of the Noble 30 members, right? So it just shows together also with Novartis. I think Novartis has even a 30% stake in Roche, and they are both headquartered in Switzerland, and I think 3 kilometers distance from each other. So I'm sometimes wondering who's really the boss here. Is the family or Novartis? When you read their reports. So yeah, I think it's a nice company to have. And sometimes I'm just wondering, like what you just mentioned with this, imagine that indeed cancer would be curable. How would they earn their money? I
mean, a lot of people get cancer at the moment. I mean, there's 6 billion, 7 billion people in the world. I mean, they cure it, but just because they cure from that person, I'm sure they won't eliminate it. Cancer will still probably be about.
It becomes then more like a service company, I think. If you think about it, right? It becomes a service instead of a drug. So maybe we will see this like the CEO of Roche 10 years from now talking like Tim Cook. We want to move, or like any tech companies, we want to move our portfolio from a licensing model or something like that into a service model.
Yeah. I mean, it fascinates me. I never would have considered quantum computing and a healthcare company. I'd never put them into the same sentence. And then you just Google, just a quick Google, and you'll see the research that they're doing. And I mean, it's incredible what can be achieved. It's really inspiring. And I mean, I got the feeling from that company that they are more about the patient than making money. Obviously, they're a company, they want to make money, but I didn't get that feeling from them. So that really, my only concern is the currency fluctuation, and there is this 35% withholding tax as well from Swiss companies. So, I mean, it's quite high, and the currency fluctuation. If they were in euros, it'd be a no-brainer for me. But the Swiss franc it does fluctuate. I think you look back in 2015, 2016, and you see, particularly to the US dollar, you can see the fluctuation is quite extreme.
Yeah.
So
I believe there was even a certain moment that the Swiss bank recalibrated their currency. That's why there was like then a really strong drop. And I remember here in Poland that many people that had a mortgage in Swiss francs really got screwed up with that. Hence why banks are not allowing really anymore here to have a mortgage in Swiss francs, but rather in the local currency.
Yeah.
Yeah, I mean, the only disappointing thing about all the pharma companies in Europe is they hardly gave dividend increasements, like 1% here, 2% there. And you see them all flattening in their dividend payouts. While if you look at their underlying numbers, they're all looking pretty good. So it feels like they're more cleaning up the balance sheet over the last 2-3 years.
Yeah.
And I would love to see some return to dividend growth, like 6-7% dividend growth again. They have the balance sheets.
I'm not too concerned. We know European companies are more conservative in times like this, and we know this. And I'd much prefer that they are conservative now while times are uncertain, and then when we get back to normal, the increase. I much prefer that. It gives me more confidence in the balance sheet. I mean, their payout ratio is a little bit on the high side for me. It was near 70%. They're trying to reduce it down, obviously, but no, I have no issues with the rate that they're increasing at the moment.
Super. Well, nice pick, EMF. Nice one. Okay, this brings us to the end of the show. I think it was a bit a long one, but there's so many earnings this week, and we only addressed only few still of them. So I hope to everyone that stuck with us to the end of the show, I hope you enjoyed it. I hope you find it informative. And what we're also trying to do is we're trying to get more reviews on our show, because we noticed that more listeners will find us then, because it will help the ranking in Apple Podcasts and such. So if you haven't done yet, and you were willing to even stuck to us until the end of the show, the best thing you can do is to show us your appreciation at the moment is to leave a review. Other than that, of course, we'll meet you on Twitter again. So everyone have a great week and enjoy the upcoming earnings again.
Adios.